Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, I'm looking at the topics we're covering today. Very important topics. First off, unfortunately, more Americans are using their 401ks for financial emergencies. This is something I really worry about. I know it's down the road for people, but we want to discuss that, why it's not a good thing. Inflation report, showed some positive and some negatives. Chase and I will discuss that. And then this week, Tuesday, national debt surpassed $37 trillion. What does that mean to you? We'll talk about that as well. And then, as always, we've got some companies to cover for you. Chase, what do we got?
Yeah, so companies we're going to take a closer look at today includes Intel, United Health. We're also going to look at Nexstar and then Bloomin' Brands. As always, we'll break down the fundamentals, give you an idea of what we think if we to buy, sell, hold, based off the valuations and balance sheet and all the different factors that we consider.
All right. Well, let's talk about, unfortunately, more Americans are using their 401k for financial emergencies. And I'm sure some will disagree with me based on the headlines arguing that we're so happy that they had their 401k to tap for whatever their financial reason was, emergency was. In my opinion, however, people are thinking short term and not thinking about the long-term crisis when they retire 20, 30 years down the road. And that might be so bad that they're in a poverty level situation because their 401k was not large enough to generate a decent income. And well, Social Security could be far lower than they thought it was. It just really scares me that people are thinking short term.
Yeah, and it is always just such a hard thing to see when somebody's like, maybe not even I want to retire. I have to retire. I can't work anymore. And so you look at their retirement accounts, I don't know what you're going to do.
Yeah.
And, that's not the situation you want to be in, especially like you're living out your last years. I think you want to be comfortable. You don't want to be waiting to die, essentially, which is a really morbid way to put it. It's a really sad way to put it, but it's the truth. If you have no money in retirement, there's nothing really to live for because you can't enjoy your retirement.
And you'd hate to be 65, 70, have to be Walmart greeter, work at McDonald's. I mean, that is not what you want to do. But we got more to talk about here, but it's just something that's really dear to me that people need to stop taking out their 401k. Yeah, that emergency sounds bad now, but it's not going to be nearly. Imagine 20 years living in poverty.
Yeah, I mean, it could be longer. I mean, you kind of bring up this point, but when you look at how fast medical technology is moving, I mean, in 20 to 30 years, you may be spending more time in retirement than the 20 years or so that you were thinking. I mean, you could be, 65 and it's like, I'm not only going to be retired for 10 years. That might not be the case. You might live to 95, even 100. I mean, shoot, you could be in retirement now for 35, 40 years, and you could be in retirement almost longer than you were working, which is just a crazy thought for some people to fathom. And I mean, the numbers are just so frightening when you break them down. And I've thought about this so many times, but it's just like, why did we do this? Why did we give so much access to the 401k when you had the pension system years ago? You couldn't call up your boss and be like, hey, I know when I'm 65, I'm going to get this great pension, but I want the money now instead. That wasn't an option. Why did we change it where the 401k, you'd be like, hey, actually, I want some money. I think that was a huge mistake.
Well, here's something frightening came from Vanguard. 2024 saw a record of 4.8% of workers that took a hardship distribution for financial emergency. That was more than double the 2% level just 5 years ago in 2019. And this one really bothers me. It really frightens me. Even more frightening was nearly 33%, of one-third of people decided to take their cash in their 401k when they changed jobs, in spite of the fact that they were paying taxes and penalties, as opposed to rolling that into an IRA rollover or putting it to your new 401k plan, your new employer. This is just terrible that people, we've seen it here at our firm.
Yeah. And I want to rephrase what you said because I don't think it came across clear. You said take their cash. No, they didn't take their cash in their 401k. They decided to cash in their 401k. So sell everything. Let's say you had $5,000, $10,000 invested in your 401k. I'm not going to take it and move it into an IRA. I'm going to take it and I'm going to spend it.
Yeah.
that is, again, what we're talking about here. Cashing in is just the worst thing, especially you take into consideration the taxes and the penalties. I think penalties in the Fed is, 10%? I think California charges at 2.5%, plus then it's taxable. I mean, you're talking about losing about half of that to taxes and penalties.
And we've had it happen in our firm, and we try to talk to people, and sometimes they're younger, and they say, that's only $5,000, $10,000, $15,000. What does it matter? Well, because you're young, you're missing the compounding effect. And again, you're losing half of that money many times to the government. It makes no sense. And sometimes, people say, no, I just want it. We try.
I mean, you think about, again, what we'll call $10,000. Let's say you lose $5,000 to taxes and penalties. You just want to rip up $5,000? I mean, that's basically what you're doing. And you put it in that perspective, but that's not how people view it. They're like, it's there. I didn't really think about it, so whatever. And it's just, I think, so detrimental.
Yeah, and that $10,000 are taking, look at the future value of it, depending on how long you're going out, could be $75,000, $80,000, $100,000 that they took from their retirement.
Yeah, I mean, it's definitely not the right thing to do. And unfortunately, I mean, you talk about these, I'm going to say, quote unquote, emergencies. A lot of time, hardship withdrawals, there's a full list of things that qualify for a hardship withdrawal. And it seems like Congress, they keep adding different types of hardship withdrawals that makes it easier and easier for people to pull money out of their 401k. And I think that the Congress that actually set up the 401k in 1978 under the Revenue Act of 1978 did not envision that rating the 401ks for these emergencies would occur to the degree that we're seeing today. And again, I'm pretty confident in 1978 that Congress felt it would be a great retirement plan for all Americans, not an emergency fund for paying off debt, for traveling, for, again, spending that money rather than saving it, again, for retirement. That's what it's for. Keyword, retirement.
And I think back in 1978, the Congress, maybe they were a little bit smarter, but I think they were planning ahead saying, Social Security may not be enough, so we better do this 401k thing to really help people out. And I think they're rolling on their graves saying, what? They get to take it for any reason? Pretty much. I mean, it's very liberal on what they do on the emergencies, I guess they have.
I'm going to go as far to say that this was kind of a test on why we need Social Security. I'm not a big proponent of Social Security because I think it is not the most efficient use of capital, but we need Social Security because if people were to be trusted, if everybody were to be trusted for their retirement, they'd be screwed.
Yeah.
The 401k was kind of a test of that because we were so based on a pension system for so many years where people were taken care of by their companies. And people with 401ks, in my mind, are even taken care of better by the companies with matches and different programs, but they don't capitalize on it.
Right.
And that is the big problem. And it's just, I think, unfortunate to see.
Yeah, and it's a tool that you can use. If you use it correctly, 401ks are great. Use it improperly, they're terrible. And I highly recommend before people take money out of the 401k, they need to talk to a real, not a salesperson, but a real financial professional to understand the taxes and the penalties that you're paying. It's not just the taxes and penalties, and one should also figure out the future value of what that account could have grown to and how that withdrawal could devastate the retirement. Because you grow this big amount, then you take the monthly amount, where you keep taking this out, like, what? I only get $1,000 a month off of that account? It's because you took so much out of it. It's terrible.
Yeah. No, I mean, otherwise you take more, then you run out of money 10 years into retirement. Because it's like, oh, wow, I have $100,000. It's like, that's not going to last you very long.
And I've had that happen with our clients where we tell them, they get, and they call up, I need $10,000. Like, your money's all gone. Well, what am I going to do now? I said, I talked to you 10 times over the last 5 years, and you still took it. So I don't know. There's no answer to it. So protect that. That's so important, that 401k. Don't be taking it for almost. I cannot find a good reason to take it. Credit card debt. The one I hate too. Oh, down payment for a home. You think that's good? How many clients have we had that they get cash or real estate rich and cash poor, and they lose a house because they can't, afford it. So it's.
I'll say I can't think of one right now, but I'm sure there is. But point being, there's not enough good reasons to really be like, it's a great idea. Right. And I'm sure somebody could be like, well, actually, I took it and it helped me in this. And okay, fine. But that's a very, very, very small percent. And I want to emphasize very, 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 because I think it is so limited.
I'm sure there's one I can't think of. But again, when you weigh it, because people don't weigh it. They don't weigh the long-term effect, what's going to be like in retirement, because they don't have a good retirement. Yeah. So that's going to last, as you said, much longer. Let's talk about inflation, because the report showed some positives and, well, some negatives as well. The July Consumer Price Index, also known as the CPI, showed an annual increase of 2.7%, which was in line with June's reading and below the expectation of 2.8%. The headline number was helped by energy, which showed an annual decline of 1.6%, largely thanks to a decline of 9.5% for gasoline. And we know that gasoline, except for in California, is declining quite a bit across the country.
Yeah, and the unfortunate thing is that won't be repeating probably next year. I don't think you're going to see another 10% decline in gasoline, but I mean, you never know. But I was kind of surprised by this. I haven't really broken this down before, but energy services were not as favorable when you looked inside the energy reading for CPI, as they increased 5.5% for electricity and 13.8% for utility piped gas service. I do wonder if the power demand for these large data centers is starting to put a strain on the grid, and I worry this could become even more problematic. I mean, we're talking about all the billions and billions of dollars that these large companies are plowing into data centers. They're not all built yet.
No.
I mean, I feel like they're coming up with this idea before really considering how are we going to power this stuff?
Yeah.
And I was reading this article the other day about people are not going to be happy if the power responsibility falls on them to power the data centers. If their electricity bills go up because they're near a data center, I don't think they're going to be too stoked on that. It's like, oh yeah, Meta and Microsoft, you make all these billions of dollars, and my electricity bill went up 15%. Thanks.
And it is true because you don't really think about it. I mean, electricity up 5.5%, natural gas, gas service up 13.8%. There's times now like, I'm not going to take that jacuzzi because I know it's all natural gas, and it bugs me when I see how much it's increased over the years now. And you're right, it may only get worse going forward.
They got to come up with a plan for it. I don't know what it is, but I did read some maybe municipalities, some of the larger utility companies are maybe having direct negotiations with the Metas, the Microsofts, and saying maybe they're going to have to pay a different price for electricity than their residents, because again, they don't want to piss off their constituents and be
Right.
like, oh yeah, we're bringing this data center here to create all these jobs, but also we screwed you over on the electricity side. So I mean, I think there is going to be some negotiations, some potential changes that occur, because we know that demand for electricity and power is going to go up because of these data centers.
Yeah, and there should be maybe a top tier that you're using all this energy, we're going to charge you a lot more.
Yeah.
So, but let's talk about the core CPI, because that does exclude food and energy. Well, it was up 3.1% from a year ago and was slightly above the forecast of 3%. This was a slight increase from the 2.9% level in June and the highest annual increase since February. Surprisingly, shelter, we've talked about this every month, I think, for the last 24 months, continues to be a large reason for the elevated inflation rate, as it was still up 3.7% compared to last year. I know it's getting better, but it's still there, and it makes no sense.
Yeah, and I was reading this other thing in Barron's this last week, and they were talking about how the CPI was calculated, I think it was in the 80s, and they didn't include the owner's equivalent rent, which we've kind of been questioning, I'd say. And they didn't talk about what inflation would look like now, but they talked about like inflation back in 2021 or 2022, whenever it got really bad and we hit 9.1% on CPI. If you would have calculated it based off the 80s when you used home prices, it would have been like 19%. And I bring that up because I think we're on the inverse of that now. If you were to actually include the way we calculated inflation in the 80s, home prices are not up 3.7% compared to last year. So you would actually probably have a more subdued inflation report. But you kind of have your puts and takes with how you calculate inflation. It's just maybe not as bad as the headlines and the core is showing, because I think that shelter, as we've said for many months, is somewhat skewed.
Yep.
Also, we talk about tariffs. If you didn't know, tariffs have been a pretty hot topic.
Oh, yeah.
So they appear to be subdued. I mean, I was kind of looking at different areas. I mean, furniture, that was up 7.6% compared to last year. So that is something that maybe is being impacted from the tariffs. A lot of foreign, manufacturing for furniture. So that could have been an area. But other areas like apparel and new vehicles, those saw little change. New vehicle prices are up just 0.4%, and apparel prices are actually lower by 0.2%. Again, two big categories that have, I'd say, more foreign exposure than other products.
And that's one thing that surprises me, those numbers as well. You have to ask, who's absorbing these tariffs? Is it the company? Is it the consumer? Obviously, this shows not the consumer on cars yet, but someone's absorbing those costs, which eventually will be passed on. I mean, usually they're just not going to thin air, so that does worry me. And I did see an economist point out the fact that core goods inflation on an annual basis registered the largest growth in over 2 years. But at 1.2%, I wouldn't say that it's putting a strain on the economy at this point in time.
Yeah, I just think it's so interesting because, the tariffs, and, I've kind of talked about this before, how we're a service-driven economy, not a goods-driven economy. So you're seeing, again, at 1.2%. If we had 1.2% inflation on the whole economy, we'd be in a great spot. And I was actually surprised, too, because the president talked about how he wasn't happy with Goldman Sachs and their kind of modeling on the economy. But I dug into the report, and even with their numbers, it was kind of strange. It wasn't that bad. They talked about how tariffs might cause a 3.2% core PCE when in June, it was at 2.8. That 3.2% level was by the end of the year. So again, you're talking about how awful maybe these tariffs could be, and core PCE would still only be 3.2%. It's just not a big enough part of our economy. If we were a heavily driven import-based or country for goods, that would be a problem. But we are so service-heavy, I don't think it's moving the needle as much as people thought it would.
Yeah, and then we talk about Producer Price Index, the PPI, which is known as PPI, had a big headline miss as a monthly increase of 0.9%, greatly exceeding the expectation of 0.2%. This is something that, when we question, maybe perhaps they're absorbing the tariffs. That's why they're seeing the inflation not passing to consumers yet. But I was surprised at that. I was surprised, but I wasn't surprised. I guess.
I was somewhat surprised by it. But again, I think maybe you will see some of that flow through to consumers by the end of the year. But again, even looking at Goldman, they said they think consumers will absorb, I think it was like 2/3 of the tariffs by the end of the year. But that's why even that inflation rate, 3.2, is not that bad. But I mean, when you look at PPI, that monthly headline was what made the news, but you look at annual gains of 3.3% for the headline and 2.8% for core PPI, it just doesn't look that problematic. And again, goods inflation for the month was 0.7%. It's services what really drove the miss in my mind, as it increased 1.1%. But one of the main areas was portfolio management fees surged 5.4%. I can guarantee you, portfolio management fees have nothing to do with tariffs. That's because the stock market went up so much in the month.
And I'm looking at that. Did we increase our portfolio management fees? I think we stayed the same fee for how many years?
Well, but no, because the stock market goes up.
Oh.
So okay. You're seeing that big surge. And I mean, I'll tell you, we didn't have as good as a month as a lot of people in tech. So if you were all in NVIDIA and all the tech stuff, and again, we've talked about our concerns there, but a lot of people saw a nice increase last month because of their exposure to technology.
That's interesting. Yeah. And again, we always say, when our clients do better, we do better. So we do make more.
And I did want to say one last thing. Sure. I don't know if you're going to hit the retail sales.
Yeah.
Okay, perfect.
Yeah, July retail sales showed a nice gain of 3.9% compared to last year. And that was even more impressive when excluding, this is amazing, a decline of 2.9% at gasoline stations, as growth was 4.5%. And then food services and drinking places, gosh, I'm surprised at this, advanced 5.6%. Well, people are still out there spending money. They're doing great.
And, when I saw CPI, I was like, I think the Fed should definitely cut in September. And I think maybe 2-3 cuts by the end of the year. And then you get this retail sales data, and you're like, but the economy is actually still doing pretty well. Yeah. I can see why some Federal Reserve members are skeptical of cutting. But then you have to kind of balance, well, you don't want to cut after you're in a recession. Right. You want to try and beat the curve. So, I mean, I see the argument to both sides on if it makes sense to cut or if it doesn't make sense to cut in September. I kind of would like to see, I guess, more data in September before that Fed meeting, but markets basically have it priced at 100% right now that they're cutting in September. It'd be very bad for the market if they did not cut.
And I think with the retail sales growing 3.9%, I'd say, you know what? I wouldn't, if I was on the board, I don't think I'd be cutting. Now, if it gets down to 0.1%, because I don't think it's going to reverse dramatically from 3.9% down to -4. Yeah. But I think I'd want to see it a little bit lower. We will see what they come up with. But I see the point for not cutting.
Yeah, I agree. And I hate to say that because I've been so adamant that I think they should cut. But, I mean, that's why you continue to look at data and you can have a fresh opinion. And, you got to change as the data changes. And right now I'm not going to say I'm like, oh, they definitely shouldn't cut. But I think I would go either way. I mean, it's kind of nice. You have the dissents on the Fed right now, and then you have the people that don't want to cut, because I think you have people like myself that's maybe 50-50, and they could be swayed either way based off the arguments made.
Yeah. And,
Which is good.
And what I look at too, if you cut, you've used up one or two of your bullets already.
Yeah.
And I think we're going to save those until things get pretty bad or worse. So, but speaking of bad, what does a national debt surpassing $37 trillion mean for you? Well, on Tuesday, August 12th, the United States national debt surpassed $37 trillion for the first time ever. The debt is growing at about $6 billion per day, but that appears to be better than last year.
Yeah, and in July 2024, the national debt passed $35 trillion, and then November 2024, it passed $36 trillion. So looking for some positives here, it did take 9 months for the debt to grow another trillion to the $37 trillion mark, and also, too, that percentage gain is smaller because the numbers are getting bigger.
Yeah.
So, at least that debt accrual is maybe slowing down a little bit.
Yeah, like $6 billion a day, that's about a little over 4 months that it would hit the next level, based on my quick math there.
Yeah, what was that, 30 times 400? Yeah.
Yeah, something like that. So, and at the end of the second quarter, another important thing, debt to GDP stood at 119.4%, which is manageable, but we really don't want it to go much higher than that. We're getting to a level to where we can hopefully see a slowdown in debt expansion, or maybe even a reversal, and still have the increase in the GDP. That'd be perfect. That'd be the optimum we want, is a reduction of the debt and still have GDP grow. That'd be great.
Yeah, and you get to this kind of spot. I mean, generally you want national debt. It's good. It's a good thing for people to invest in. You're not going to have a national debt at zero, but we've gotten, I think, so debt heavy from COVID that it might not hurt to again, maybe have a reduction in that debt as we move forward. And the reason is that, having a high national debt, it's negative. It takes investment out of the private sector because people have to be buying that national debt. I mean, as I said, it's an investment for people. If you're not putting it into the national debt, you can put it into other avenues, which that could slow down the growth in the economy. And also, a large national debt can cause interest rates to increase, as the need for more debt often means offering higher interest rates to attract buyers. It shocked me when rates were, 1-2% that anybody was buying that. But, you shouldn't be. I mean,
Right.
I don't know why you would buy debt at 1-2% unless you thought but even if you thought the economy was going to go to zero, you wouldn't be buying debt because it'd be useless. It just made zero sense. So you need an attractive yield on it so people will buy it. But, that's the concern is, at 4 or 5, I mean, that's kind of, not a awful deal. That's where it might need to stay to have buyers have interest.
Yeah, I mean, there's a lot of problems to it, and I don't like it coming out of the economy because that will slow down our growth. But it is something that needs to be looked at, needs to be addressed. I know the current administration is trying to do things, but gosh, it's just and raising taxes, that is not a positive. That will hurt the economy more, and then you get less revenue.
Well, because you get less GDP growth.
Yeah.
And then, you get less revenue, you get less GDP growth. So then your debt to GDP could even skyrocket more than you thought.
Yeah, it is something that you want to be careful of, and hopefully they will fix this for us. But you want to do a company?
Yeah, let's jump into it.
Yeah, okay, let's jump into Intel. Intel's in the news today. We'll go over the numbers. Chase will explain a little bit more about the news item that they had today. But Intel, symbol INTC, semiconductor industry, 2.8% shares float. We do see no PE ratio because they've had no earnings over the last year. Industry, 60.8% or 60.8, very high. Price of sales, 2 versus 13.4, so Intel better there. Price of book value, 1.1 versus 11.3. Price of cash flow for Intel looks good, 10.6 versus 36. And the PEG ratio looking pretty good for Intel, 1.6 versus 22. Now, last year, even the last 5 years, Intel shows no earnings. We do see sales for Intel last year down 3.7%. I don't get this one. Well, maybe I can because the earnings are so low. But the 5-year EPS growth from the analysts, 102.4%. So they're expecting earnings to grow quite nicely. Intel does not pay a dividend any longer. They cut that dividend, I think, last year. I think it was, wasn't it?
Last year, 2 years ago.
Yeah. Current ratio, 1.2. That's okay. Debt to equity, 0.5. That's okay. Net profit margin, a negative 38.6%. They need to make a profit. We do see that they also have return on equity of a negative 20.9. Just looking kind of kind of sick here as far as the numbers go for Intel.
Yeah, I did look it up. It looks like their dividend was actually about a year ago. Looks like August 6th, 2024 was the last dividend they paid. Looking at the current price, though, for Intel, again, their ticker symbol is INTC. It's $24.56, 52-week range. The low here is $17.67, and the high $27.55. This has not been a good performer over the last 5 years. It is down about 49.8%. Last 10 years, down about 10%. So it's definitely struggled, to say the least. And unfortunately, I mean, it's crazingly still expensive.
Yeah.
And I say that because you go out to December 2026, estimated earnings per share of 66 cents give you a target sell of $10.96. Now, the hope is that they can get back on track and get that earnings growth, because obviously they had no earnings. This year they're looking for 13 cents. Next year, 66 cents. So that's a 417% gain. That's why the 5-year estimated growth is so high, is because you're starting off such a low base. But
and what concerns me is what you're going to talk about, where the government wants to actually hold stock in it.
Yeah, I mean, that just blew me away. I was very surprised, to see the government announce interest potentially, and it lifted Intel stock. I think they were up 7% after the news, and then another 3-4% on Friday. And yeah, the government said that they were in talks to buy a stake in Intel, which would help fund factories Intel is building in Ohio. And I have such mixed feelings on it, because we need to be building chips here in the U.S. Right. But if we are controlling or having the government be involved in private businesses, how is it any different than Huawei in China?
Oh, exactly. And I believe the Biden administration, didn't they give them a couple $1 billion?
Like $7.68 billion, somewhere in there is a good amount of money.
Right. And I would rather have the government give them money than actually get into the equity business of these companies. And I will say the current administration, I think they're kind of getting a little bit too business-oriented to kind of be in businesses, talking about Goldman Sachs, talking about who's the CEO they want to get rid of, too. He said they need to...
That was Intel. Yeah,
was Intel.
But then he flipped, and he said he's got a great success story after he met with him. At least he's, malleable and can change his mind, I guess. But
even before that, you shouldn't be... I don't care what the president says about a certain CEO, what that CEO is doing.
I don't think it's the government's role right now to be investing. We don't have capital to invest. We have so much debt that it's like somebody taking all this credit card debt to go buy stocks.
Yeah.
I mean, we should not be buying cryptocurrency. We should not be buying stocks. I just...
Run the government.
I think it's a very slippery slope, and especially then as a private company, what does that mean for the stock? Does that mean you got to buy? I think there's just too much speculation.
Yeah, I agree with you. All right, we'll take a break here. When I come back, our CFP, Harrison Johnson, is going to be talking about changes coming to charitable giving. Stay with us. You're listening to the Smart Investing Show with Brent Chase. We'll be right back. All righty. Welcome back to the second half of the Smart Investing Show. I forgot to promote the newsletter. The newsletter is something that will really help you out a lot, because these topics we talk about come from the Smart Investing newsletter. It is free. Goes out every Friday at 5 o'clock to your email. Things in there that we didn't talk about were pack your bags. It's a good time to visit Las Vegas. It looks like customer service at the Social Security office is improving. There's been a big surge in delinquent student loan accounts. Eastman Kodak, is it still around? Well, it is. You can read about that. And our producers eating the tariffs and the consumer. Well, we talked about still spending. So that's at the Smart Investing newsletter at our website, smartinvesting2000.com. It is free. Goes out every Friday at 5 o'clock. Don't miss yours. You'll be a smarter investor if you actually get it. All right, let's talk about financial planning. For that, we turn to our financial planning expert, our CFP, Harrison Johnson. Harrison, how you doing?
Doing well. Good to be here as always.
Well, good. Let's talk about changes coming to charitable giving.
So, this tax bill passed about a month and a half ago, 4th of July of 2025. So some of the changes in it impact how charitable giving is going to be done. So one of the things that is going to be coming into play is people who claim the standard deduction are now going to be able to deduct some charitable giving, cash donations. It's up to $1,000 for a single filer and $2,000 for joint filers. So generally speaking, a charitable donation is an itemized deduction, so you need to itemize in order to write that off. But now people who claim the standard deduction can have either $1,000 or $2,000 deduction for cash donations. So that's something that reduces taxes, so that's a positive. On the other side of things, for people who itemize, there is going to be an implementation of a 0.5% AGI floor. So basically, if you itemize and you write off charitable donations, the first chunk of that is not going to be deductible. So only charitable donations that exceed 0.5% of your adjusted gross income become deductible. So if you have income of $200,000, 0.5% of $200,000 is $1,000. So that means if you make charitable donations, the first $1,000 is not deductible.
You know, every year it gets more and more complicated because, well, you get this, but you got to have the 0.5% to this, and then it's not the full amount because it's only this number.
Well, yeah, it's. I'm not sure why this happened, because it's gonna. What it'll do is it'll de-incentivize people who make small donations every single year. It's not unlike the medical expense deductions that you have, because right now, out-of-pocket medical expenses are an itemized deduction, but you can only deduct the amount that exceeds 7.5% of your AGI. So this is kind of like that. The floor is much lower at 0.5%, but it still, adds that floor. And then another change in there is for people who high income earners who are in the top tax bracket, which is 37%. If you make a charitable donation and itemize it, instead of getting a 37% deduction, you only get a 35% deduction. So it kind of limits the tax savings for high income earners on making charitable donations.
I chuckled because I, number one, think the complexity is just silly. And number two, I was like, oh, that's great. I can deduct some of my charitable donations that I do every year. And now I just realized I won't benefit at all from this because of the AGI rule. So it's like, man.
Yeah, it's kind of interesting. The other thing, for the people who claim the standard deduction, it's $1,000 or $2,000 of cash donations can be written off. That functions as an above the line deduction. However, only people who claim the standard deduction actually can claim that. So if you itemize, you don't get the option to, we'll just donate $1,000 or $2,000 and write that off. You are subject to that 0.5% AGI floor at any income level. And then as you get into that 37% tax bracket, which you're not there, Chase.
So the AGI thing doesn't apply to me.
If you donate to charity, a portion of it is not deductible because of that AGI floor. So that will influence everybody.
Yeah. He might get a $500 deduction.
Yeah.
You might get a $500 instead of, whatever it is.
I'm not going to tell people how charitable I am, but,
Well, and this stuff, a lot of the things with this bill was active 2025. This stuff doesn't go into play until next year, 2026. Okay. So if you claim the standard deduction, you might want to wait until next year because you'll actually get a tax benefit for it. Or if you itemize, or if you're in that top tax bracket, you might want to accelerate some of your charitable giving and doing it this year because those limits are not in place yet.
Now, as a CFP, a lot of people think, I'll talk to my tax guy, my CPA about the charitable deductions. Do you look at this for clients to see if it does benefit them, their cash flow, all these things? Do you put that in the equation?
Absolutely. It's definitely a part of it. And no matter what you do charitable-wise, you're still being charitable. It's just a matter of how much tax savings you get. So, if you donate $10,000, maybe you can write off some, and maybe the cost to you, maybe it saves you $3,000 or $4,000 in taxes. So you're still netting out a loss, but a lot of people are charitable for different reasons. They give to their church or they give to causes that they believe in. And if you're going to do that, we want to do it in the most efficient way so that you can, save taxes or give more if it's a cause that you believe in.
I guess that is my question. You look at to see the most efficient way to do it for them so they get the charity, but plus most efficiently.
Absolutely. It's a big part of it. And the nice part about this is now there are some benefits coming back for people who claim the standard deduction. Back in the COVID area, there was like 2 years where standard deduction filers could write off some cash donations, and then that went away. So that's coming back in some capacity. But again, the timing of it, the amount of it, whether you use donor advised funds, whether you're doing charitable remainder trusts, whether you're donating stock, whether you're donating cash, whatever it is, if there's a cause that you believe in, you want to do it in the most efficient way. So it's important to be aware of these rules, because if you're used to doing something that's the same every single year, with the influence of this coming in 2026, that could dictate the timing and the level of charitable giving that you do.
And I think some of your initial meetings with the clients that you get, I think you said that many times, a couple hours. So much to cover.
I had one this week that was a little over 3 hours. So,
Wow.
I mean, they take a long time. No, that's not the initial meeting. The initial meeting's about an hour or so. But when I'm presenting, the
plan,
a whole plan, it can take a while because, well, we'll talk about charitable stuff if you're charitable. We'll talk about taxes. We'll talk about cash flow. We'll talk about retirement, Social Security, Medicare, structuring income, moving, in-state, out-of-state, real estate, loans. I mean, everything that has a dollar influence or can influence your finances, we take a look at. So it takes a while.
And this is why I say somebody doing the investment part and financial planning, there is no way they spend 3 hours just on financial planning. They just
Probably not, because I'm not selling anything. You're not gonna spend 3 hours doing something if you're not really making money on it. Not selling a product, or Also, it's not 3 hours of me beating somebody saying, "Okay, invest your money," and like selling
annuity.
Selling annuity or like timeshares or something. Yeah, locking somebody in a room. You have to be in here for 3 hours, and we'll give you something. So yeah, it's all just about what makes the most sense, and there's a lot of layers and complexity, so that's why it takes so long.
Right.
I was just going to say the largest charities I give to are the federal government and the state of California.
Well, but you did run a foundation for how many years?
I did run a foundation for 4 years, and then now I serve as treasurer for the Urban Street Angels. If you are looking for a great charity, I think they're fantastic. Youth homelessness. I think they're actually tackling homelessness the right way, which it's a huge problem in the county of San Diego. So, I wouldn't even say I'm biased. I went in there, with no financial gain. I make no money from it. So I just think they do a fantastic job.
And the reason, too, is that you now have 2 babies that are a year old or younger. And it's like
8 weeks, yeah.
So
8 weeks and 18
busy.
months, yeah.
When they get older, you can do more charity work.
Yeah, we'll get
But
back
you do
to
quite
it.
a bit right now. All right. Well, Harrison, thank you very much. Appreciate it. And we'll talk to you next week.
Thanks a lot.
All right. Again, Harrison Johnson, he's a CFP with Wilsey Asset Management. If you want a free consultation with him, and again, he's a fee-based financial planner. He does not sell products. And you want to say, gee, maybe it makes some sense to talk to a true financial planner, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or send him an email at smartinvesting2000.com. Again, that's smartinvesting2000.com. All right, what are we going to talk about now? I guess United Health had some news on Friday, so let's talk about that one. United Health, symbol UNH in the healthcare plans, been in the news quite a bit over the last, I'd say, few months.
Yeah. There's been some big news with United Health.
Right. But a few months, I think it's been about 3 or 4 months, I think it's been in there. But
no, the guy was murdered last November. I mean,
really?
I think it was like October, November. I think it was late last year is when really this all kick-started.
I mean, time eludes me. I mean, it just goes by so fast. But is it now time to buy United Health? Well, let's check on the numbers here. Again, their symbol UNH. PE ratio, not too bad, 13.2 versus 14.6. Price of sales, 0.7 versus 0.4. Price to book value, 2.9 versus 1.9. Price of cash flow, 9.7 versus 10.8. And the PEG ratio, 1.3 versus 2.3, and that's a positive. We do see last year their earnings are up 52.9%. The industry is only up 16%. Sales for United Health, well, they grew by 9.7%, which is better than the industry at 7%. The 5-year earnings per share growth estimate, this is surprising how much they've been in the news on negative stuff that they've had out with, is 15.7% above the industry at 14.1. Now, they do pay a dividend, 2.9%. They use about 37% of their earnings to pay that dividend out. And then taking a look at the balance sheet, current ratio is 0.9, better than the industry at 0.7. Debt to equity only 0.8, same as the industry. We do see a net profit margin here of 5. That's double the industry at 2.5. Return on equity looking very good, 22.5 versus 17.5. And their free cash flow, hope you're sitting down here, Chase, $25.2 billion. That's double the industry at $13.6 billion. So numbers looking pretty good here.
Yeah, I mean, they're a behemoth in the healthcare space. Obviously, they do the health insurance. I guess they own like some because they've been a target of, I'll call it monopolistic type situation as well, because they have the doctors network, they have the PBM, PBM, right? That's the pharmaceutical type situation. And then I'm blanking on what it stands for.
Pharmacy Benefit Manager.
Exactly. That's what it was.
Just popped in my head.
Yep. And then I'm supposed to be the young one with the memory there. But, and then obviously the health insurance side. But they've carried that premium valuation for years outside of this year. Because, you look at the current price for United Health, it's $304. It was up 12% on Friday. We'll get into why in just a second. But, even with that climb, over last year is down 47%, year to date down 39%. They have really run into some big issues revolving around the business. And I'm going to say, unfortunately, going forward, even with all the issues and the massive decline, I see estimated earnings per share of $19.25. It gives a target sell price of $319.55. So it is slightly above the current price of $304.01, but I wouldn't say it's necessarily attractive given all the concerning measures that they have to go through.
You said $19.17?
$19.25.
$19.25. Okay. That is down about 37% from just 90 days ago when it was about $30.54. So these earning estimates have come down a lot. But unfortunately, it's still not a buy. But there's other people out there that are today, on Friday, came out.
Yeah, the big news was the 13F filings, and we don't know when these purchases occurred. So, they could have occurred at the bottom of, United Health. Cause I didn't give the 52-week range, but let's see, the 52-week low was $234.60, so it definitely presented a better value here. And I remember looking at it on air and saying, the value's looking like it's finally there, but all the question marks were surrounding it. But people went with it, and when I say people, I mean big people. Berkshire Hathaway revealed a stake of 5 million shares that's worth about $1.6 billion. The big short investor, Michael Burry, and then Appaloosa Management's David Tepper. He owns the Carolina Panthers, so I know he's a very prominent hedge fund manager. They also disclosed sizable stakes in the company. That's why United Health was up so nicely on Friday, again up about 12% on the day, which that's a big move for a company like United Health.
And I'm kind of disappointed based on our, stringent numbers that we use. We can't say it's a buy because I think you said there's only a few percent away from the target sell price. I think so, but I think it's worth watching.
And I guess I know why. I think there's other health insurance companies out there that are much better value plays when you look at the valuation ratios. But I think the reason United Health has always carried that premium valuation over them is because of the various business lines. It's a more diversified entity than some of your other health insurance plays. And again, it's the largest one out there, so maybe it has some weight to carry that premium valuation, but it still carries the premium valuation even with all the problems they're going through over other health insurance companies. So I think there's better options out there in this particular space.
We own the other one that we think is a better value.
Maybe that's why I'm saying that.
Yeah, I think so. And it did get a little boost from this because, again, it also shows that, Warren Buffett, David Tepper, I forget who else you said. Michael Burry. Concerned like, the government's going to hurt healthcare. Well, these guys are not stupid guys. They're saying they know about that. They're saying no. And I agree. We still need health insurance, and they still need to be profitable companies. And I think United Health got maybe overdone. But I think there's an area to look at. And again, we're not talking for a trade. We're talking to buy a business for 2, 3, 4, 5 years.
Yeah. I was very interested when it fell. If we didn't have the health insurer that we did, I think I would have been very interested when it was, down around the 240 range.
Yeah. So.
And I did want to say the other interesting news out of the 13F situation, and it's so funny that, all the headlines were, Buffett reveals secret stake, and United Health was the big kind of notice, but he also did resume sales of Apple shares. And I say resume because he didn't make any sales, and I say him and his team at Berkshire Hathaway didn't make any sales in Q1 of this year or Q4 actually of last year, it appears. But they sold another 20 million shares of Apple in Q2. Last time they sold was Q3 2024. They sold 100 million shares. In Q2 2024, they sold 389 million shares. So it looked like he, and they, I guess I should say, because I don't know how involved he is at this point, wanted to resume selling a little bit and paring back that position.
And actually, as you said, didn't really hit the news anywhere.
No, I was shocked by that.
Yeah, and Apple's only down about $1 or so on Friday. So, and it has rebounded from the low 300. What was that? Low 200s to about 230 it closed.
We know why, right? I'm being facetious here. No, it just seems like everything in this market, it doesn't matter what the numbers are. It's all what happens in the news, and it's because Tim Cook was standing next to President Trump, and on that day, it went up because they're going to be spending more money in the United States. And it just, to me, it was a silly reason to see Apple stock go up. And they reported a decent quarter, but if you look at their growth rates over a 3-year period, it's trash. I'm going to say that. I'm going to put it out there. It's not a good growth rate given their valuation for that type of growth from a quarter that I was not that impressed by. I think was silly.
And you see the, I don't know what to call it, award, I guess they gave to Trump, or the kind of like a trophy or something. It was a one-of-a-kind symbol or something, and then it was on a solid gold base. It was probably worth, I'm going to say, a few $1 million. I mean, like, and I know that Tim Cook wasn't really a favor of Trump, but now he's president. Like, oh, here's a $1 million gift.
If you can't tell, I still do not like Apple as an investment. I got my iPhone, not in my pocket, but at my desk. I got my iPad, but it just makes zero sense if you're being objective to the valuations of it. And Buffett still has a large stake in it. I don't know why, frankly. I think it's just so overpriced. I can't see the argument. I guess maybe he thinks it's like a Coca-Cola where it can carry a premium valuation because of that, but I just don't think there's any growth in it. And I could be totally wrong, but I think 5 years from now, it will be a mistake to buy Apple at these levels.
I was on vacation for a couple of weeks and went with a few other people, and another person said, I got rid of my Apple phone. I love my Samsung. It is so much better. They show me the
pictures.
I
hate hearing that.
Oh.
Because Samsung is not an American company.
I agree with you. But it's also, too, it's kind of worrisome for Apple. Yeah. So, and I love American companies. I like Apple, and I like Boeing. But, gosh, they got to do good business.
Yeah.
So,
I agree.
All right. Let's talk about broadcasting. For that, we'll talk about Nexstar. We got to be careful here because we both work for Nexstar on Fox 5 and KSI.
Do we volunteer? I mean, we're not paid guys.
We're not paid guys, but we're commentators. So, But then the broadcasting industry, not a good start here. The short on the float is 8.2%, about 100% ownership, institutional. Wow. We do see a PE ratio. They got one, 10.9 versus nothing for the broadcasting industry. Price of sales, 1.2 versus 1. Price to book value, 2.8 versus 1.2. And price of cash flow looks good, 4.7 versus 5.3. And the PEG ratio, only 0.2. Industry doesn't even have one. The lower the PEG ratio, the better. Wow. The earnings are up 50.2% over last year. That's double the industry at 25.8. Sales for Nexstar, they were up 6.6 when the industry was down 5.3. The 5-year growth rate on the earnings chase from the analysts, 69.5% versus a decline of 16% for the industry. So Nexstar seems to be doing all the right things. Ooh, we might be buying this company. They pay a dividend of 3.6%, only use 37% of their money to pay that dividend out. On the balance sheet, I'm hoping something good here. Current ratio, 1.7 versus 2. Debt to equity, not good. This is what worries me about buying more companies. 2.8 versus 1. Net profit margin, 11.9 versus 3.7. Did want to look at their return on equity is 27.8. So they probably have a low equity based on that. And that could be why the debt to equity is so high. So maybe not a problem there. If you're going to look at the company, you really got to look deeply at that. Free cash flow, not a lot. It's $1.2 billion. The industry's at $400 million. So I kind of like everything I'm seeing here. But what do you got going forward?
Yeah, I mean, I'm going to say it's interesting. I mean, you look at Nexstar again, the ticker symbol NXST. The current price here, $206.36. I'm blown away by this. The 52-week low, $141.66. The high, $212.44. 1-year return is up about 28%. But I'm even more blown away. The 5-year return, gosh, if I can click on it, is 125.7%, and then the 10-year return on Nexstar, 341%. Did somebody forget to tell them that nobody's watching TV nowadays? I mean, that's what it is. It's a broadcasting company.
And as we talked about, that doesn't include dividends. With dividends, it's 399% 10-year return, and compare that to the S&P at 267. So they've done a great job here. I mean, well, obviously we're on air, so I guess that we're helping there.
I guess. I mean, shoot, maybe they should give us a dividend. But I mean, that's what they do is they own TV stations. I mean, and it looks like they're agnostic to whatever it is. I mean, it says that stations are affiliates of ABC, NBC, Fox, CBS, the CW, My Network TV, and other broadcast television networks. So it doesn't look like they're like, oh, we're primarily just associated with Fox stations.
Right.
They just own the different stations and the different markets. And what kind of surprised me, did you already bring up the Tegna news?
I did not.
Yeah, I mean, that's what kind of put them in the news here was Tegna, which is one of the other large players in the TV station business. Now, I guess they're in advanced talks for Nexstar to buy Tegna. So, I mean, Nexstar could get even larger in this space. And, I mean, maybe the cash flow on this is just amazing. I was actually talking to somebody at Nexstar, and they were saying, I don't know the exact ins and outs of it, but they primarily try and buy more now in, like, your swing states.
Right.
Which makes a ton of sense because that's where you'd probably get more money from the political advertising.
Right.
It's pretty much a nice cash flow machine, I would assume. With all that said, I haven't given the target selling price yet, so let me do that, and we can maybe continue the conversation real quick. But going forward for Nexstar, we go out to December 2026. I mean, this is interesting. I see estimated earnings per share $25.74 gives us a target sell of $427.28. Forward PE around 8.2 times. I mean, there's a lot to like. Just that balance sheet is a no-go for us.
And I don't know if you saw the 2025 earnings. And my numbers are a little bit different than yours, but 2025, $14.07. Mine shows an increase to $26.54.
Yeah.
So why are the earnings nearly doubling? I'd want to know that before.
Maybe integration costs. Maybe they have had all these buys, and now they've integrated stations, and now those integration costs are subsiding. I'm just kind of speculating here because, I mean, sales aren't going up 95%.
Yeah.
Pretty sure by that. So
Yeah.
it has something to do with expenses
Yeah,
and
cost side
maybe
of it.
non-cash expenses to that degree as well.
I think this might be worth a little bit more research because
Did you say the debt to equity was, though, 400?
yeah, but we think it's got such a low equity. It's kind of like a franchise company, maybe. You know, franchise companies have such low equity. This may be a similar business model. I'm questioning.
Maybe.
Yeah. Because remember, I looked at the return on equity; it was really very good. So that kind of told me probably a low equity.
Yeah,
So
that makes sense.
yeah. So, but I'm going to put a potential buy in this one.
Yeah. If you can understand the debt. I mean,
Well, yeah, you got to kind of, and again, you know, we try to point people in the right direction, and that's what we're trying to do now. It's like this one, I think, is worth doing some research. It is a growing company. I would want to look at the debt, and also too, you talk about the buy with Tegna. Is that going to be a debt deal, equity deal? That could change things a lot. I think Tegna is not that small of a company.
no, I think it's a decent-sized business. It's in the billions, I believe.
Right. We got to move on here. Gosh, time's going by quick here. Let's talk about, let's see, we're going to talk about Bloomin' Brands. Have you ever eaten there?
Yeah, actually, I looked up because they have Fleming's. I love Fleming's. It's a
Oh.
great little steakhouse.
I thought it was Outback Steakhouse. Was
It
the
is. I mean, that's their big one. Outback Steakhouse, Carrabba's Italian Grill, Bonefish Grill. I'm not familiar with them. And then Fleming's.
one. Okay.
They only have, I guess, like 70 total, 70-ish total Fleming's.
Yeah.
It's primarily Outback, 670 locations around there. This is as of 2024.
That's Friday. Yeah, that's good.
Yeah.
All right, let's look at the numbers here for Bloomin' Brands. Symbol is BLMN in the industry of restaurants. Wow, short float, 11.7%. A lot of shorts on that company. We do see they got a PE ratio of 7.9. That's very good. The industry's at 30.8. Sales 0.2 versus 2.4. Price of book value 1.5 versus 17. Price of cash flow. And again, these are valuation ratios. You want them lower. 2.5 for Bloomin' Brands versus 16.9. PEG ratio 0.6 versus 15.5. Valuations of this company looking very good. Earnings over the last year up 207% versus 0.3 for the industry. However, sales for the Bloomin' Brands are down 14% when the industry is up 4.4. Analysts give a 5-year earnings per share growth rate of a 17.8%, better than the industry at 8.2. Wow, they pay a dividend of 8.6%. But the payout ratio shows not material, so there's something there that they're kind of missing on the earnings side. But could see a dividend cut there at 8.6% going forward. Let's see here, balance sheet, current ratio 0.4 versus 1.1. That to me says nope, I'm not going to touch this company. They could have a liquidity problem, especially when I look at the debt to equity now, 5.4 versus 1. Very heavy debt, not a lot of liquidity. Net profit margin is minus 0.1%. Return on equity in minus 1.2. I don't know if you have anything good going forward, but I was very excited about this company, and now I'm not.
I mean, valuations look good. I mean, Bloomin' Brands, the current price is $7 a share. 52-week range, the low $6.09, the high $18.72. I mean, it's not been a good performer over the last several years. It's really seen some difficulties. But going out to December 2026, estimated earnings per share $1.10. gives a target sale of 1826. And one thing I was thinking about, this company is obviously franchised. It is primarily company-owned restaurants, so it looks like as of last year, about 1,100 were company-owned, about 300 were franchised. But I was thinking, if they don't own the real estate, the way that leases work is they still show up in debt. So if you have all these leases on the balance sheet, that is all liability. You don't have the asset for that. You're paying with the lease from cash flow. So it could really make the debt to equity pretty nasty, like it does here. And also on the current ratio, maybe if they have some leases coming due, that's short-term debt. So I don't want to say, yes, go ahead and buy it, but just kind of trying to reason through it.
More research, though. Yep. All right, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Go to the website, smartinvesting2000.com. Again, smartinvesting2000.com. Great information there. Sign up for the newsletter. Thanks for listening. We'll be back next week right here on the Smart Investing Show.